No, I don't think so. I don't think either technically or from a sentiment perspective, leaving aside the fact that we have no idea what the next month or two or however long it is going to result in terms of the impact of the virus on the economy, what the containment measures are going to be. You know, companies are withdrawing earnings estimates. They're not just guiding down. So leaving all those uncertainties aside, you know, it is a typical pattern if you are sort of finding a bottom, and I don't know whether we are, to have some retests, to see relatively weak breath on attempts at rallies, and then ultimately you sort of retest and you have a much stronger breath move on the upside. We obviously haven't seen that yet. I don't think we've seen a significant enough reversal in what was incredibly frothy sentiment that registered at the highs in January. So I think leaving all the actual factors that are driving this aside and just looking at your standard sort of technicals and sentiment, even there, it doesn't quite look like we're there yet.
So add it all up, Lizanne, and what are you guys at Schwab actually telling your clients to do right now?
Well, we haven't made any recommendation changes for the last 3 years. We've been, from a tactical perspective, what we call neutral to equities, which just means don't go above your normal long-term allocation to equities, and that's going to vary by investor in terms of how they're strategically positioned. We've taken a spread around that of overweight large caps, underweight small caps, and on a relative basis, I think that's still the way to go here. I think the profit fundamentals, the balance sheets, the percentage of zombie companies, I think is heavily still biased toward the higher quality, larger cap companies. But what we've really been pounding the table since early 2018 is in this more volatile environment, be more cognizant of, number one, diversification across and within asset classes and more systematic and frequent rebalancing in order to take advantage of these swings and kind of basically stay on the right side of the trade, so to speak, trimming on the moves down to the extent it's been significant, or trimming on the way up and adding on the way down. It's kind of tried and true, typical disciplines that we always espouse, maybe even more important in this environment.
Michelle, as a head U.S. economist, how do you try and gauge the impact on the U.S. economy? And roughly speaking, how much lower do you think it would have been than it otherwise would have been?
Yeah, so obviously that's the big question, and every day it seems like we're learning a little bit more about how this might feed into the broader economy. So you first think about the direct hit, which is through a supply shock, and you can kind of gauge that. You can look at how supply chains are disrupted. You can get a sense of how production may or may not return, and you can understand a little bit about the business reaction. So that's understandable. You can pencil in the inventory drawdown. What I think gets a lot harder is around the consumer reaction, whether or not behavior is changing. And that can happen swiftly, and it could also happen driven by what's happening in the market. So if consumers are worried about their health, they're worried about their finances because of what's happening in the stock market, they start to become a lot more cautionary. They change their behavior, and you start to get an adverse feedback loop develop between what consumers are doing, what markets are doing. Is that what you expect? So, no, I mean, I think we're seeing it a little bit. I think it's inevitable. But no, we don't expect to see, a real painful one that brings down the global economy. But I think at this point, there's just scenarios that we can play with. And we have to think about all these different linkages and be willing to adjust forecasts as we see the data come in, as we see that high-frequency data, which are going to be surveys and sentiment shifts.
Stephanie, where do you stand on whether the market's selling off because of fears of a recession or just wild swings in sentiment that move stocks, even if we don't think GDP is going to fall that much?
Oh, I definitely think there's fears of a recession because we can't model anything, as we've talked about last hour. Here's the thing, though, guys. The Dow's only down 8% on the year. The S&P's down 7.5%, and the Nasdaq is down 2.6%. It feels so much worse, though, right? Because of these major swings. And I think we talked about earlier, it's really more algorithmic related, and it's hard to get caught up in all of that. So that's why I have said many times you don't want to go all in, but I do think there are stocks and sectors that are down way more than the averages, that have gotten punished beyond belief, that you have to take a stand, especially if they are blue chip, number one in their industry, and you're getting them on sale.
So just remind us what exactly you've been doing with that advice today.
So I have been picking, and we talked about some of the names that I've been buying. AbbVie was yesterday. It's yielding a 5.1% dividend yield. Zoetis is a name that I've never owned, that I totally missed, and it's only down about 7% on the from its high. So it's still expensive. That's one that I absolutely want to buy. It is the number one animal health company in the industry, phenomenal management team. I am looking at some of the financials. The one area that I'm not really aggressive on. I'm not really aggressive on technology because those stocks are still up on the year. Some are up double digits. I know you want to own some growth, but I think you want to have those companies come down, particularly the FANG stocks.